100% of the time for the past 80 years in a row, during a midterm election, the stock market has bottomed out in October and it has gone up in November and December. Hi guys, it's Stock Curry, and despite the downright scary US economic situation right now, there is strong evidence that the stock market will bottom out in October. In today's video, I'll explain why, so let's get into it! The Dow Jones Industrial Average tumbled 500 points on Friday to end September down nearly 9%. This was not an accident. High inflation and the Federal Reserve's actions spooked the markets in September, and there's strong evidence that that scary market action will continue in October. Let's take a candid look at where the risks lie in the stock market right now so that we can make some smart investing decisions. Normally, at the end of a bear market, we see one final epic crash where stocks move down in a significant way. Typically, a large downward move of 10 to 20% all in 1 week is not uncommon. As the Federal Reserve ramps up its efforts to fight inflation, this is sending the dollar surging, and it's causing bonds and stocks to sell off. This is causing concern to rise that the central bank's campaign will have unintended and potentially dire consequences. The markets entered a perilous new phase last week, one in which statistically unusual moves across asset classes become commonplace. It is the once-in-a-generation rise in the dollar that has captivated market observers. Such US dollar strength rises have historically led to some kind of financial or economic crisis. The Federal Reserve may have to stabilize the price of treasuries here. We're getting close, according to Connors, a market participant for more than 30 years. What's happening may require them to step in and provide emergency funding. You might recall from some prior videos how I explained how the stock market will always bottom out and start going back up again once the Federal Reserve either increases the monetary supply by printing money, or they stop quantitative tightening and start quantitative easing again by buying bond assets, or they start lowering the interest rate once again, that the stock market will always bottom out and start going back up again. Well, if the Federal Reserve is forced to provide emergency funding in order to prop up treasuries, doing so will most likely force the Fed to put a halt to its quantitative tightening program ahead of schedule, just like the Bank of England did. Last week, when the Bank of England decided to do quantitative easing and start buying treasuries, that caused the US stock market to rise almost 4% intraday. Imagine what would happen if the US Federal Reserve or the US Central Bank decided to do quantitative easing. The stock market would not just rise 4% intraday, it would rise and continue to rise as the Fed starts putting money back into the stock market. Now, even though the Federal Reserve's actions to reverse course and start propping up the stock market again would cause the stock market to rise, historically, while October is the bottom of most bear markets, it is also historically the time where we see the largest number of market crashes. And the reason for that is usually the stock market will have one final epic sell-off before it actually bottoms out. And there are a couple of indications that we might be very close to that epic sell-off that will mark the end to the bear market. There is a worry that whipsawing markets will expose weak hands amongst asset managers, hedge funds, and other players who may have been over-leveraged or otherwise took on unwise risks. While a blow-up could be contained, it's possible that margin calls and forced liquidations would further roil markets just like it did at the end of 2008. The rising correlation among assets in recent weeks reminds Dunn, an ex-risk officer, of the period right before the 2008 financial crisis when currency bets imploded. Carry trades, which involve borrowing at low rates and then reinvesting in higher yielding instruments, often with the help of leverage, have a history of blow-ups. The Fed and all of the central banks around the world, their actions are creating the backdrop for a pretty sizable carry unwind right now. A carry unwind is when asset managers have borrowed large amounts of money at very low interest rates, and then they reinvest that money in higher yielding assets such as bonds or stocks. But when the prices of those start to decline, and as the cost to borrow starts to increase, this forces asset managers to unwind all of those assets in order to avoid major margin calls. What this does is it causes stocks and bonds to start coming down in price at a very rapid pace. It causes a massive sell-off in bonds and stocks, and this leads to this epic final sell-off right before the entire stock market and bond market bottom out. In addition to those concerns, we also have the problem of these so-called zombie companies that have managed to stay afloat because of the low interest rate environment of the past 15 years. Most likely, these companies are going to face a reckoning of defaults as they struggle to tap more expensive debt. And this could lead many of these zombie companies to go out of business, just like we've seen in every major recession in the past. In 2001, we saw 60% of dot-com companies go out of business. And in 2008, we saw 40% of companies worldwide go out of business. So there's certainly a lot of history here for these so-called zombie companies to actually default and go out of business during a major recession like we're in right now. And that is why I am staying away from any and all companies that are not profitable and have bad balance sheets. If you look at the stocks that I've been buying lately, they have all been stocks that have been profitable for the past 4 quarters, and they're all stocks that have more assets than debts so that they can weather a major recession. Now, unfortunately, the fact that central banks have been raising rates in order to fight inflation is causing a clash with the needs of governments to issue bonds. If central banks continue to raise interest rates, they will continue to raise the cost of servicing government debt, and that could put millions of government workers out of work. Now, if we suddenly have millions of government workers out of work, that is going to significantly increase the rate of inflation and will deepen the recession in the United States as well as around the world. And while many of the problems that we're facing in the US are due to the dollar's rapid rise, inflation is keeping the US from stepping in to slow it down. The reason for that is the higher the dollar's value is, the lower inflation is here in the United States. Unfortunately, a strong dollar poses significant risk for a global financial crisis. And while that strong dollar has helped to keep inflation down in the United States, unfortunately, there are signs that inflation might start rising once again. OPEC is weighing a production cut in order to increase oil prices. Keep in mind that an increase in oil prices will cause inflation to go back up again, which will force the Federal Reserve to raise interest rates even faster. That in turn will cause stock and bond prices to continue to fall. And as stock prices have continued to fall this year, investors are now betting against an 80-year record of the stock market going up in November and December after a midterm election. Now, personally, I think this 80-year record is going to hold. I think the Federal Reserve is going to step in to help boost the price of bond assets in order to help the federal government pay off their debts. I think the Federal Reserve is going to stop their quantitative tightening. They're going to switch to quantitative easing in order to help out the U.S. government, and I think the stock market is going to rally because of that. Keep in mind that for the past 80 years, 100% of the time for the past 80 years in a row, during a midterm election, the stock market has bottomed out in October and it has gone up in November and December. That has been true through every major recession in the past 80 years. That has been true through the extremely high inflation environment that we had during the 70s and 80s. That has always been true for every single period in the last 80 years. And I see no reason why it would not be true once again. So for that reason, I am betting that the stock market is going to bottom out. I am betting that this 80-year record is going to hold, and I am betting that stocks are going to go up in November and December. By the way, on average, if you buy stocks in October, on average, during a midterm election year like we're in right now, the stock market is up an average of 15% 1 year from October. Now, to be clear, we're not out of the woods yet. We still do have this one final epic crash that normally happens in October, and Tesla might help kickstart that. Tesla delivered 343,000 vehicles in the third quarter of 2022, but it was expected to deliver 364,000 vehicles, so it fell about 20,000 vehicles short. This is just another sign that the economy is slowing down, and even Tesla can't deliver vehicles as fast as they would like to. Tesla being one of the most heavily weighted stocks in the S&P 500, this could put a significant downward pressure on the S&P 500 on Monday, kickstarting a sell-off in stocks for October. Now, taking a look at the economic news that's coming out this week, we don't have any major economic news, but we definitely have a few things to watch out for that could move the markets this week. On Tuesday, we get the August data on job openings. This is going to help give an update to how many job openings there are for available workers. Every single month, we've seen the number of job openings come down, and we are expecting the number of job openings to come down again in August. On Wednesday, we also get the Commerce Department's report of U.S. trade deficit. This could help give an indication of where our GDP might be for Q3. Then on Thursday, we get the weekly U.S. applications for unemployment benefits. Now, last week, this was exceptionally low, and that's not good for the U.S. economy because it means the Federal Reserve could raise interest rates much faster than expected since the job market remains strong. So if the unemployment rates are low again for this week, that could be really bad for the stock market. Now, Friday is the big one. We have two major economic news that's coming out on Friday. Not significantly major, but it will be major for the week. The first one we have is that the Labor Department is reporting the state of the U.S. labor market for September, and this is going to show September's job gains as well as the official unemployment rate. So we're really going to have to watch this one for the job market for September. And then the S&P Global releases its September survey of purchasing managers measuring economic activity in China. Keep in mind that China is the world's second largest economy, so if we see a major slowdown in China for September, this will hurt all of the world economies and especially the US stock market. So hopefully this video helped you get prepared for this week and the month ahead. If you got a lot out of this video, be a good friend and go share this with your friends and family so that they will know what to look out for in the stock market this week as well. And if you like this video, make sure to hit the like button and subscribe to the channel for more videos just like this. And as we near what might be the bottom of this bear market this month, now is a great time to start dollar cost averaging into some stocks, especially value stocks that are already beat down. If you want to see my top 5 value stock picks, make sure you go watch the video that I uploaded earlier right here.